Welcome back to financial statement analysis. This week and in this video, we're going to be analyzing profits. Profitability analysis is in the CPA exam in the BEC section, in the performance management part 2 section. It's also in FAR in the ratio analysis section. And although I don't have it available, it's also part of the audit section when you're doing your performance analysis for audit procedures. Let's begin and talking about analyzing profits. There are four major what? Not that type of profit with the F? Oh, that does make a little bit more sense. Sorry. This week we're going to be analyzing profits. We're going to take a look at gross profit margin, operating profit margin, net profit margin, ROA, ROE, and then we're going to be breaking down ROE and looking at the DuPont ROE and the extended DuPont ROE to try to determine what are the drivers of a company's profitability. In this video, I'm going to be walking through various profitability ratios, their definitions, and then how we can interpret them and what some additional information we want to know about them. In addition, I would like for you to take out a piece of paper and while you're working through this, actually write down these ratios because I didn't want to spend time formatting them in PowerPoint, and I think a lot of times it's easier just to write these ratios out. So let's start with our gross profit margin. And throughout this video, we're going to be going back and forth between the PowerPoint. We're going to be looking at 10 financial statements and online on the SEC's website, and also writing out notes on a piece of paper. So let's start with our gross profit margin equal to gross profit divided by sales. And of course, gross profit is equal to sales minus cost of goods sold. Now let's talk a little bit about the gross profit margin. Gross profit margin measures the markup or the spread between the cost to make or buy the products, right? Because some companies are actually producing the goods that they're selling, and some goods are the merchandisers are just buying completed goods, marking them up, and then reselling them. So the cost to make or buy the products and its selling price. How can we interpret declines in gross profit margin? Well, here's just a couple major reasons that might lead to declines in gross profit margin: an increase in competition, or any other reason for a decrease in demand for the product. And that could lead to the management responding by lowering the selling price in order to stimulate sales, so leading to a decrease in selling prices. Another reason for declines in gross profit margin: an increase in the cost to make or buy the products. You might be hearing in the news a lot about inflation concerns right now, that the cost of goods the raw materials are going up, and then the companies that have to incur these higher costs need to determine, can we raise our selling prices? How will the market respond? Or do we need to take the hit and reduce our gross profit margin if we need to maintain our selling prices even though our suppliers' selling prices are going up? Next, let's look at operating profit margin, also known as the EBIT margin. Remember, EBIT is earnings before interest and taxes. Operating profit margin is equal to the company's operating income divided by sales. So let's write that down and then go into it. Operating margin, sometimes called operating profit margin, and sometimes called EBIT margin, all mean the same thing. Operating income as a percentage of sales. Operating profit margin measures the profitability of the company's core business operations. So we know we're working our way down to net income as a percentage of sales. Why might we want this interval step, operating income divided by sales? Well, this is the most sustainable type of income for a company. It's related to what that company is in business of doing. And so how well did we retain our sales dollars as operating income? What is not included in operating income? Investment income, interest expense, income tax expense, And so why might we want to pull out these items that I've highlighted here and just focus on operating income? Because these items are less controllable, they're less predictable, and they're less likely to help us predict future income. But at the end of the day, what really matters to the investor, to the stockholder, is net income. That is the amount that they own after all expenses and costs are accounted for. So our net profit margin, also called profit margin, is equal to net income divided by sales. The net profit margin measures the profitability of each dollar of sales. And for all three profit margins, as you know, the higher the better. Calculated and analyzed these profit margins before. We just didn't use the terms. But remember, early on in the semester when we did our common size or vertical analysis, we calculated the gross profit margin, as you can see here. We calculated the operating profit margin. This is the income statement and common size analysis of Apple that I had used in a video earlier on in the semester. And we looked at the net profit margin, all in our common size analysis, because everything on the income statement was shown as a percentage of sales. So of course, sales is the driver for just about everything else on that income statement. Now let's move along to return on assets, or ROA. The sole reason that we invest in our inventory, the reason why we have our accounts receivable, our plant, property, and equipment, why we might acquire another company, is with the final intention of earning income on all of those assets. So ROA says, how productive were our assets in producing income? So this is a way of measuring the efficiency of assets. And why do we use average assets and just net income with no average? Remember, net income covers a period of time, where assets are at one particular point in time. So we're comparing net income for, in our case, the entire year. If we just look at assets at year end, we're missing part of that story. To get a little bit more of a bigger picture of what happened throughout the year, we take last year's ending assets, which was this period's beginning, and this period's ending, which is what we see on the balance sheet, divide by 2 to get the average. Let's put ROA down on our formula sheet. Now we can break ROA up into two components to get a better idea of what's driving our return on assets. So we can break ROA up into profit margin, which we see here as net income divided by sales, and asset turnover, which is sales divided by average total assets. ROA is a function of the profit margin, and let's put in some notes here. The profit margin, how much of our sales remain as net income after all the costs are accounted for? And we've already talked about profit margin. And now we're introducing this other component of ROA, asset turnover. How well did our investment in assets produce sales? Because although of course we want our assets to produce income, the first thing that those assets have to produce before they can become income is sales dollars. So we already have profit margin on our formula sheet. Let's update our formula sheet with asset turnover. And let's also put in this expanded ROA, because we want to look at ROA not only as net income divided by average total assets, but also as profit margin. We're drilling down to get more information up from that ROA, profit margin times asset turnover. where profit margin is, as we mentioned before, net income divided by sales, and asset turnover, as we just wrote up here, sales divided by average total assets. So we're saying one component, how profitable were our sales dollars after accounting for all the costs incurred in running the business? And then how many times did we turn over our investment in assets? How efficient were our total assets in generating sales dollars? Let's take a look at an example on the next slide with some numbers. So if a company has a profit margin of 11%, that means for every dollar of sales, the company retained 11 cents as net income after covering all of its costs of running the business. If a company has an asset turnover of 1.6, that means for every dollar invested in assets, the company produced $1.60 in sales revenue. So of course, if a company has a profit margin of 11% and an asset turnover of 1.6, its return on assets, we multiply the two, 17.6%. Here in this next slide, we see some ROAs of specific companies. Now, this is a few years old, this sheet, but at least it gives us some information. Let's start here and look at Walmart, for example. Is this about what we would expect? We're saying Walmart has very high asset turnover, but very low profitability or profit margin. Does that make sense? Well, that's exactly what Walmart's business model is. Where would we expect Target to be compared to Walmart? We would expect Target's prices are a little bit higher, so we see a little bit higher of a difference in profit margin and a little bit lower of an asset turnover. Of course, if you charge higher prices, you're going to probably that's going to result in having fewer sales. Now, a lot of these companies, I wouldn't know exactly where to expect them to be. You know, Walmart is an extreme with their business model of very low prices, very high turnover. I didn't really know, I can't really explain exactly why Apple has such a higher profit margin and a relatively higher asset turnover as compared to Microsoft, shown here. But again, this is at one point in time, and so it has a lot to do with how the company performs in that period. Let's move along to another measure, return on equity. Return on equity is equal to net income and divided by average total stockholders' equity. So this is another measure of the efficiency of what the company is using to generate income. And whereas ROA looked at our investments in assets in producing income, ROE takes a different view of how is our stockholders' equity, the total ownership, book value ownership of the company, how well is that doing producing income? So let's add that to our formula sheet. And we're going to spend some time breaking down ROE into various components to better understand performance of the company. ROE compares net income, as we can see, to the company's book value of equity. Book value of equity is another way of saying total stockholders' equity. You're probably familiar with the term market value of equity. Be careful not to get confused not to confuse market value of equity with book value of equity. Market value of equity is equal to the number of shares of common stock times the price per share on a specific date. And market value of equity is not used in return on equity. Total stockholders' equity is also called the book value of the firm. It comes directly from the balance sheet. So if we want to take a look at, let's say, here we have Tesla's financial statements. Let's look at Tesla's balance sheet. If we want to see what is the book value or what is the total stockholders' equity of Tesla, we come to this line, the total stockholders' equity. Now, we see here they separately have the non-controlling interests, so we would have to actually add those two. But what's behind stockholders' equity? If there's any preferred stock, common stock, additional paid-in capital, accumulated other comprehensive income or loss, and typically what we see is retained earnings. We see with Tesla, rather new company, has a negative retained earnings, which is known as an accumulated deficit. So we see here Comes directly from the balance sheet, contributed capital, retained earnings, accumulated other comprehensive income, and if the company has purchased its own shares back, we might see a specific line for treasury stock. We can analyze the drivers of ROE rather than just looking at net income over stockholders' equity. We can break this down into the components of net income and see what is driving our ROE. ROE is a very commonly used measure from the stockholder's perspective of our value, at least according to the books, according to GAAP, which assets minus liabilities is our stockholders' equity, our claim to the company. What's driving the performance for us? The most basic way to break down ROE is to look at return on assets multiplied by financial leverage. We already discussed return on assets, net income divided by average total assets. Now let's introduce this term financial leverage. Financial leverage is average total assets divided by average stockholders' equity. Whereas return on assets is stated as a percentage, financial leverage we usually state as a number. Let's take a look at financial leverage in a little more detail. Think of leverage. We're typically thinking about how much does the company use debt or liabilities in financing its assets. And you'll notice that there's no measure of debt included in this. And last week when we looked at solvency analysis, and we were very concerned with how well can a company pay off its liabilities and not run the risk of bankruptcy. Remember, we looked at total liabilities to assets. And we looked at total liabilities to equity. And we looked at liabilities to equity. So it might look strange that we don't actually include assets here. We don't actually include liabilities in this formula here. But if we think about the accounting equation as assets equals liabilities plus stockholders' equity, well, we can drop out one of these components, or we can drop out the other one of the components. And when we're comparing the other two, we know that the other one that's left out, we can infer information if we're leaving out just one of these. So if we look at the average total assets, how many times greater are our assets than our equity? Well, how else can we be financing? If we're not using equity, we must be using liabilities. And so the higher the financial leverage, the more times greater that our assets are over equity. Well, the only other way to finance our assets is with debt or liabilities. So the higher the financial leverage, the greater the use of liabilities to finance assets. Consider two companies. Company A has assets of 100 and equity of 60. That would give us 100 divided by 60, financial leverage of 1.67. So we can see here exactly how much debt the company uses if we know the assets and the equity, 40 in debt or 40 in liabilities. Let's look at company B, assets of 100 and equity of 30. So we can see here that the company has 70 in liabilities to finance its assets. That's going to give it financial leverage much higher, twice as high, 3.33. Let's put financial leverage and our extended analysis of return on equity onto our formula sheet. You might be wondering at this point, what does leverage have to do with profitability? And we will see that in just a moment. And we can look at ROE, not just as net income over average stockholders' equity, but we can look at ROE as return on assets times financial leverage, or net income divided by total assets times average total assets divided by stockholders' equity. We're going to extend our analysis of the components. They're the drivers of ROE beyond what we've seen so far. we're going to break down this measure ROA into its components. So we're leaving financial leverage, and now let's see how much detail can we get, how much more information can we get from this ROA. Rather than just simply looking at net income over assets, what if we broke down net income into its major components? So what are those major components on the income statement? Well, one of them, here we see Tesla's simplified income statement. We have revenues, gross profit, operating expenses, and then operating income. Remember, we already talked about the operating margin or EBIT margin, operating income over sales, measures the portion of sales remaining after covering cost of goods sold and all operating expenses. So of course, the higher the operating margin, the higher the ROE. This is telling us how well did we do, did we run our business? How efficiently did we run our business? So that's going to be one component of our extended ROE analysis. What else do we see here on this income statement? After operating income, the next item that we see is net interest expense. So now notice in this formula for interest burden, we don't see anything about interest expense here. You see interest expense here, but not in this formula. What's in our interest burden formula? We have pre-tax income, which is same as income before taxes, and we're comparing that to operating income. So if we say what percentage of our operating income is our pre-tax income, what will this tell us information about? This will tell us our information about how much of our operating income is going towards taxes, or sorry, is going towards interest. So it measures the portion of pre-tax income that a company retains or keeps within the company after paying for interest. If operating income differs from pre-tax income only because of interest expense, as you can see in this simplified income statement for Tesla, then the interest burden will be less than 1, right? Because our income before taxes of 1154 is less than our income from operations. So our income from our operating income. And so the interest burden will be less than 1 and will of course reduce ROE, because if we have a number that we're going to be looking at interest burden as a component of ROE. So if it's less than 1, it's going to reduce or take away from our ROE. And what can we say about that? The higher the interest burden, and this is kind of unusual based on the wording is a little misleading. Interest burden sounds like it's bad, but the higher the interest burden, the closer it is to 1 or the higher it is over 1. If an interest burden is over 1, that's actually going to improve ROE. And on the next slide, we'll talk about why would interest burden be over 1. So when we say interest burden, really what we're talking about is the inverse of the interest burden, because the lower the interest burden, that means more, we're retaining less of our operating income. More of our operating income is used to cover interest expense. So if a company has net interest income, not expense, but net interest income, or it has a net non-operating income. So what are we talking about here? Let's take a look at Apple's a simplified income statement from Apple. And we see here that below operating income, we have this other income of 803. So we are actually adding in this. Remember, for most companies, what we're going to see between operating income and pre-tax income is interest expense. But what else might go there? Any other non-operating gain, loss, expense, or revenue. So what does Apple have? Apple has a lot of investment income and investment revenue. So it's earning more on its investments and it's actually paying out in interest on its debt. So we see actually an improvement here. So pre-tax income will be higher than operating income. That's what we see here. And the interest burden will be greater than 1, and it will improve the company's ROE. And we see here on this next slide, there may be other items included in between operating income and pre-tax income other than interest expense. This can result in the interest burden describing the impact of, more generally than just interest expense, non-operating income or expense. So this can be a loss on the sale of loss on the sale of a building, or a write down of a building due to, let's say, hurricane damage, rather than interest expense. So this is just something we need to keep in mind as we're conducting our analysis. The measure that we're going to look at is called a tax burden. Similar to the interest burden, the name is a little misleading. I often like to think of this as tax shield and interest shield rather than burden, because it's really the burden is really the inverse of a tax burden. So while the burden sounds bad, which makes you think that higher is going to be worse, higher is actually better in the way that we're measuring these numbers, these ratios here. The tax burden is net income divided by pre-tax income, and it's the extent to which a company retains profits. So retaining the profits is their net income after paying taxes. And it's equal to 1 minus the tax rate. So the higher the tax burden, the lower the tax rate. And the higher the tax burden, the higher the ROE, based on how we're measuring this ratio. Okay, so what are we doing with these, with the interest burden, the tax burden, and the operating margin? Well, we can break down ROE into these components, or ROE into these 5 components. But remember, these components give us ROA. And we said that ROA can also be looked at as these 3 components as profit margin. ROA is profit margin times asset turnover. Oops, sorry, not plus, but times. Profit margin times asset turnover. And if we take profit margin times asset turnover and multiply it by financial leverage, we're going to get back to our ROE. So let's update our formula sheet, and then let's start using this in our analysis. So we said ROE is equal to our ROA times financial leverage. We're going to keep that financial leverage, but let's break down this ROA, net income divided by average total assets, to get more information about it. Let's look, we're going to break this down into our profit margin times asset turnover. This is ROA, as we know, and let's multiply that by financial leverage to get to ROE. But we don't have to stop there. We can look at profit margin in its 3 components to understand more about how the company is performing, the drivers of performance. Profit margin can be looked at as operating margin multiplied by the interest burden. I like to think of this more as an interest shield than an interest burden. Or just remember, with the interest burden, higher is better. See, when we're multiplying here, the higher the amount of interest burden, the higher the ROE is going to be. Multiply this by the tax burden, or I prefer to think of it as the tax shields, times asset turnover times financial leverage. And let's just write what these formulas are. Operating margin, operating income over sales. How profitable were our sales in generating operating income? Then what's the impact of that next item below operating income, non-operating income, which oftentimes relates to interest expense? So let's look at that relationship between pre-tax income, or income before taxes, to operating income. Then let's look at the impact of income tax expense on ROE. We're going to look at the relationship between net income, how much of your net income was retained after paying taxes on your pre-tax income. Okay, so these are our three measures of ROA. Multiply that, or profit margin, multiply that by the asset turnover. How well did our assets produce sales? And how much did we use debt in order to finance our operations? And instead of using debt, we're going to say, let's compare the relationship between our average assets to our average stockholders' equity. And we can see here that we can cancel out terms, cancel out pre-tax income here, operating income here. We can cancel out sales here. We can cancel out average assets here. And what are we left with? Net income divided by average stockholders' equity. Now let's turn to look at an example. For assignment 5, I've asked you to choose any 4 publicly traded companies that meet the following criteria. The companies should have positive operating income and net income. The reason for that is it doesn't really tell us anything if we have the negative ROE. So we want to look at companies that have been profitable. And we also want to look at companies whose stockholders' equity is greater than 0. So I picked a few companies just to walk through. One of the companies I didn't end up using, but that I did pick, was Papa John's, and I updated my assignment for the income statement because we see that the company does have profitable operating income and net income. And then when I went to the balance sheet to get average total assets, no problem there. But then when it came down to stockholders' equity section, I saw that the company has a negative stockholders' equity, which is the stockholders' deficit. So what does that mean? Well, if the company, this is from treasury stock, so all the company has to do is reissue the shares, get the cash, and then it will have positive stockholders' equity. Other options, though, if the company was not profitable over a long period of time and the negative equity was coming from negative retained earnings or an accumulated deficit that was greater than any of the other components of stockholders' equity, what that would mean is if the company had to end its operations and go into bankruptcy, the stockholders would actually have to put cash in just out of their own pockets to pay off the liabilities that were there if that were the case. If the company wasn't able to renegotiate its liabilities to reduce the amount in bankruptcy proceedings. So let's not use any companies. Let's take out Papa John's. Let's start with, I chose Tesla and GM. Of course, another constraint is choose any 4 companies that are not included in this analysis, of course. Okay, so let's take a look at Tesla. Tesla's income statement. We have total revenues shown here, cost of goods sold shown here, income from operations here. I see under operating income, what's in the non-operating component? And here's what we're talking about. It's not just interest expense. Now, interest expense is a major portion, but it's not everything. So just bear that in mind when we're doing interest burden, we're capturing other items besides interest. So in addition to its interest-bearing debt, the company also had investments that produced interest income. And then we have information on other expenses that the company incurred. And we don't know exactly, maybe we can look at the footnotes and find out some more information, or maybe it's not important enough and the company doesn't disclose much about its other expenses. For our purposes, we're going to net these 3 numbers to get the net interest expense and plug that in as the difference between operating income and income before taxes or pre-tax income. We're given our net income. Now I see here that the company also has some other items here. Net income attributable to non-controlling interests and a buyout of non-controlling interests. So the question becomes, what do we do with which net income number do we use? Do we use the number before we subtract out the non-controlling interests and any other unusual items? And the answer is yes. Let's use net income before considering these non-controlling items. The reason for that is, remember what the accounting rule is. If a company owns more than 50% of the common stock of another company, they consolidate 100% of that subsidiary's revenues, 100% of their cost of goods sold. So we see, even though we don't own 100% of the subsidiary's gross profit, we are reporting that here. So let's take net income. Also on the balance sheet, we're taking 100%, we're consolidating 100% of the total assets of our subsidiary that we don't own 100% in. So when we come down to the equity, let's take the total stockholders' equity and we have to add back that non-controlling interest. So I'm going to update, I have my information in Excel. I'm going to copy over my Excel information for Tesla into my ratio analysis, these numbers here. I've gone through and updated all of my underlying items and my formulas here. I want to spend a minute doing the analysis of what do these numbers mean. Tesla has a gross profit margin of 21%, so for every dollar of sales, 21 cents remains after covering the cost of goods sold. Once we account for operating expenses, for every dollar of sales, we have the company earns operating income of 6 cents. And we're typically going to always see operating margin that's lower than gross profit margin. Our profit margin of 3 cents for every dollar in sales, 3 cents remains after covering all costs of running the business and any other costs incurred, such as income tax expense, even if it's not directly related to core operations. So profit margin tells us about, these first three margin tell us about the efficiency of the sales dollars, how well we can control our costs. Return on assets and return on equity compare net income to balance sheet items. So ROA of 2% says that for every dollar invested in average assets, the company is producing 2 cents in income. That number alone doesn't tell us a whole lot. Really, it's more informative when we look at patterns over time or when we're comparing the ROA of two different companies, which we're going to be doing here. Let's break down our ROA into its two components. We already calculated profit margin up above, and we have asset turnover down below our basic ROA calculation. So profit margin is 3% and asset turnover is 0.73. So when we multiply those two together, we come back, of course, to our ROA of 2%. Again, this becomes more informative when we're comparing the components profit margin and asset turnover to another company, which we will do in just a moment. ROE, basic ROE shows that for every dollar invested in equity, we have about 6 cents of income being generated. But we want to look at that in its components. How much leverage is the company using? How much debt is it using? Well, assets are 2.8 times greater than stockholders' equity. So that's going to be one component of ROE. We can look at profit margin, asset turnover, and financial leverage together to get back to our ROE of 6%. Again, this is more informative once we compare it to a competitor. We see a tax burden of 0.75. And remember, what the tax burden tells us is if we take 1 minus the tax burden, that's an estimate of the company's tax rate. So this says that Tesla has a tax rate of about 25%. Interest burden, so how many dollars remain as pre-tax income after covering interest expense? 0.58. So we can say that an estimate of the interest rate that the company is paying is 1 minus 0.58. So we can see that a lot of the company's operating income, a very big portion of the company's operating income, is going to cover interest expense. When we multiply these items all together to get our ROE of 6%, alone this doesn't tell us much, but let's update the information for GM so then we can do a comparison. Using the interactive data on the SEC's website, I'm given total sales. I see cost of goods sold here on this line. And while the company doesn't directly report gross profit, I can easily calculate that. They give operating income here and income before taxes here. Now, when I'm just eyeballing what are the components of non-operating income, it's not just interest expense. I notice that there's got to be an error here. We can't go from operating income of 6.6 billion, subtract 4.1 billion, add about 2.5 billion and get to 8 billion. So there must be an error here. So what I did at that point was I went to, now I can just take these numbers, operating income and pre-tax income, and drop them in to my Excel file without any problem. But if I want to get a better understanding of what are these numbers, what should these numbers be, I can go to the entire 10K, and it's just same through the SEC's website, and look for where did this error happen. So the operating income matches what we saw with the interactive data, and the pre-tax income matches. But what we saw is there was an error in the reporting on the interactive data of the interest expense. So we had the company has interest expense of about 1.1 billion, but then it has about 2.5 billion of interest income plus equity income. These are types of non-operating incomes. So I'm going to use the Excel data that from my interactive data. I'm going to use the Excel-based data and copy that over into my analysis. Of course, when I'm trying to get the average total assets, of course, I can just do that once I've downloaded the company's financial statements. I can just simply come to its balance sheet and just get an average of the assets, and then do the same thing, of course, for total stockholders' equity, and then drop those numbers into my analysis. Once I have all my numbers updated here, as I mentioned before, I can just simply copy and paste. These all link. So I only have to work through those, come up with the ratios once, and then I can just paste it. Okay, now we can do some analysis. Which company had a higher gross profit margin? And then let's just do a little explanation. Let's assume that our reader of our analysis doesn't know much about what these ratios mean, and we want to provide some information to them. So let's just, in a sentence or two, let's provide some information about what we've learned with our analysis of gross profit margin. So I might say something like Tesla has a higher gross profit margin. For every dollar, what does that mean? For every dollar of sales, 21 cents remains after covering cost of sales. And how about operating margin? Tesla is higher again. And rather than boring you with having to write out all of this stuff, let me just kind of speak it, and I'll post the completed analysis that you can look at if that helps you. Tesla has a higher operating profit margin. What this means is of $1 in sales for Tesla, 6 cents remains as operating profit after covering all of the company's costs of running its business, strictly related to its core operations. Profit margin accounts for all costs of the company. The company incurred that accounting period, and we see that GM had higher profit margin so for every dollar in sales, 5 cents remains as income. So although Tesla has higher gross profit margin and a higher operating margin, we see GM has lower non-operating expenses, or as we saw, GM had non-operating income. And so it was able to earn a higher profit margin in this non-operating section. ROA, we see that GM has a higher ROA. For every dollar invested in assets, the company earned 3 cents in net income. Let's try to understand that number a little bit more by looking at asset turnover and profit margin. So we know GM's profit margin of 5% is higher than Tesla's. But we see here GM's asset turnover is quite a bit lower. So even though GM has quite a bit lower asset turnover, the fact that its profit margin was 2% higher, 2 cents per dollar higher, this resulted in a better ROA. So it's less efficient at turning its assets into sales, but GM is doing a better job controlling its expenses and having those sales remain as net income. ROE of GM is more than double the ROE of Tesla, 13%. So for every dollar invested in equity, about 13 cents was generated in net income for GM. Let's look at the components of how is this possible. Let's start off with financial leverage. We see that GM is using much more debt or liabilities to finance its operations. And think about that with the ratio, comparing assets to equity, the smaller our denominator of total stockholders' equity, the more we are using liabilities and the higher our financial leverage is going to be. If we look at profit margin compared, we see GM has a higher profit margin, uses much more liabilities than Tesla, and even though its asset turnover is quite a bit lower, it still generates a much higher ROE. Then let's break down profit margin into more components. Tax burden. Remember, tax burden sounds like higher would be worse, but the way that it's measured, for every one of our components of the DuPont extended ROE, every component, the higher the component, the higher ROE. So tax burden of 78%, what we can really say about this is the company's tax rate is really 1 minus 78%. So GM has a lower tax rate, a higher tax burden, and that's going to help its ROE. Worksheet titled Analysis 2, I've conducted an analysis, I've updated my numbers for Kellogg and JM Smucker. Let's walk through the analysis of these ratio results. JM Smucker has a higher gross profit margin. It also has a higher operating profit margin and a higher net profit margin. So what can we say based on all three of these ratio measures? We can say that JM Smucker is doing a better job controlling its costs. It retains more of its sales dollars as income after accounting for all expenses. But that's not the entire story. In order to generate sales and then end up with net income, the company has to invest in, we can look at investments either as total assets or total stockholders' equity. And let's look at investment, how effective are the assets in producing net income? And we see that Kellogg is actually doing a better job. More of its, based on it has a slightly higher average total assets, but it's producing more net income. So for every dollar invested in average assets, 7 cents is resulting in 7 cents of income is being produced by Kellogg compared to 5 cents by Smucker. Let's look at that broken down. So we know that Kellogg ROA can be broken down into profit margin times asset turnover. Kellogg has a lower profit margin, but we see here that it has a significantly higher asset turnover. So while Smucker is doing a better job controlling its cost, Kellogg is doing a better job using its assets to generate sales and therefore become profitable. So the higher asset turnover is the reason why Kellogg is able to take advantage of a significantly higher ROA. Now let's look at ROE in its most basic form. 36 cents of $1 investment in stockholders' equity is producing 36 cents in net income. And we can see that that is significantly higher than JM Smucker's. So the next step is what is driving such a big difference between the ROE between the two companies? Well, financial leverage is one major component of that. Kellogg's total assets are more than 5 times greater than its stockholders' equity, whereas JM Smucker's total assets are only 2 times greater than its stockholders' equity. Now, this is beneficial as long as the company is generating a positive ROA. If the company was to incur losses, then for a significant amount of time, the company could run the risk of bankruptcy. But at this point, as long as it's profitable, using more liabilities is beneficial from an ROA perspective. So we see that the profit margin of Kellogg is lower, but its asset turnover and its financial leverage are both significantly higher, which helps the company earn a much higher ROE. But now let's take a look at profit margin in closer detail. We see, remember, the higher the tax burden, the lower the income tax rate, so the better it is for ROE. We see that Kellogg has a lower tax burden, has a lower tax expense, 1 minus the tax burden, so that's going to help its ROE. Kellogg has a higher interest burden. Again, look at this the same way we did a tax burden. Higher numbers are going to be better because we're saying we're retaining a greater portion of our operating income when we're calculating pre-tax income. So after that non-operating or interest expense. And then how about our 5 components here? So if we're looking at ROE in all of its components, asset turnover is higher, financial leverage is higher, the tax burden is better. There's a lower tax rate. The interest burden is better. There is a greater portion of operating income that's being retained as pre-tax income after covering interest expense. And all of these factors are more than offsetting the fact that the company has a lower operating margin. And finally, the last analysis compares all 4 of the companies together to look at which one. The reason behind doing all of this is just kind of looking at these numbers and again and again to kind of get an idea of how do gross profit margins range. We see here in this example, they range from 20% to 38%. And the more we see these numbers and have to actually think about them, the more we realize that no matter the industry, we're going to have a gross profit margin probably between 20 and 60%. We're probably going to see operating margins somewhere between 2 and maybe 20%. And we're probably going to be seeing profit margins somewhere between 1% and maybe 15%. And so we're going to go through each one of these and just state who had the best measure here and what does that mean. ROA, we can see that Kellogg had the highest ROA at 7%. Kellogg had the highest asset turnover, followed next by Tesla. Kellogg by far had the highest ROE. We see how ROEs range from 6% for Tesla up to 36% for Kellogg. And then we look at those components of ROE, and we can see each component shown here. We see that asset turnover is the highest for Kellogg. It's making use of its liabilities to earn returns. It has the lowest tax rate. It doesn't have the highest interest burden, GM does, but it still has a rather high interest burden. And so even though it has the second highest operating margin, it was able to use those other components to earn the highest return on equity. Now it's your turn to choose any 4 companies and do an analysis similarly. Analysis 1, compare any 2 of those companies. Analysis 2, compare companies 3 and 4. Then put them all together, and in each one, try to give your own 1-sentence summary of what does this measure mean.